A very good afternoon to everyone. I am CA Sarvina Mandavia, moderator of today's virtual CPE meeting. We are delighted to welcome you all to the fourth virtual CPE meeting being organized by Continuing CPE Education Committee of ICAI. It is my pleasure to be a moderator for this session on OECD BEPS Action Plan 5, Economic Substance Regulation, and Non-Banking Financial Institution Laws and Planning. In a short while, we'll start the virtual CPE meeting. Meanwhile, I would love to apprise you about the CPE committee. The profession of chartered accountancy has always been recognized for the quality of education, training, and strong grip over technical standards. With globalization and increasing business complexities, it is essential that chartered accountants equip themselves with the changes occurring and stand out to the expectations of the society. Our society is constantly working and contributing to cater to the needs and requirements of our members and has taken various initiatives from them from time to time in this direction. With this view, the Continuing CPE Education Committee of ICAI has always been the foremost to provide opportunities to their members to boost their knowledge base. In today's program, we have two sessions, 1 hour each, and the topics are OECD BEPS Action Plan 5, Economic Substance Regulation. Tax evasion is happening even at the global level. To curb that, Organization of Economic Cooperation and Development, which was formed in 1961, is putting efforts on publishing guidance and action plans. Base erosion and Profit Shifting Action Plan 5 is for the harmful tax practices that are getting. The second topic is laws and planning of non-banking financial institutions, including chit fund, housing finance, HFC, Nidhi, cooperative credit societies, and money lenders. Our eminent speakers will talk about these two emerging areas of professional interest. I'll request
So, ma'am, you can call Bora, sir.
Okay. Our first eminent speaker on the topic of OECD BEPS is CA Rishabh Bora. Please let me introduce our first speaker. CA Rishabh Bora, fellow member of ICAI and his qualified chartered accountant. He has also done a certified course on rethinking international tax law offered by Leiden University, Netherlands. He is a certified financial planner. He has 9 years of professional experience in global transfer pricing and international tax. His core practice is in advising multinational corporations with Indian as well as global transfer pricing regulations in all countries, including planning, formulating transfer pricing policies, 3-tier documentations, litigation, and advanced pricing agreements. He has prepared global transfer pricing documentations, especially for the continents like Asia, Middle East, African region. His role including advising on BEPS action plan possesses in-depth knowledge of the international taxation and often advises clients on tax-efficient structuring. He is actively engaged in economic substance regulation of UAE, Bahrain, and tax havens such as Cayman Island, British Virgin Islands, etc. He frequently writes articles for leading tax portals, addresses forums in India and abroad, and undertakes training sessions at regular intervals for chartered accountant professionals, students, and also for tax officers. He's been associated with the subject on international taxation for more than 11 years. I invite CA Rishabh Bora for the deliberation on the topic. Welcome, sir.
Thank you, Sarvina, and thanks for the kind introduction. And it's a privilege to be on this platform and provide my thoughts and views on this very particular topic of international taxation, which is quite interesting and quite important as well to understand in today's globalization era, especially where the challenges are increasing and at the same time where we are going. This century is one of the biggest global tax reform at a global level. That's where the stage is to understand the complex topics of international tax more and more. So quite a privilege to be here on the stage and present this particular topic. I hope you all can see my screen right now. To begin with, let me just provide the agenda for today's session. So firstly, I'm going to cover it up, in a brief, what is the OECD base erosion and profit shifting action plan. It's important to first understand the topic itself, before we deep dive into the action plan 5. Thereafter, coming to the specific topic of BEPS action plan 5, that is harmful tax practices. It's important to understand the objectives and what is required by the companies in a way. Moving forward, I will try to cover the global updates on this particular topic. What are the principles of economic substance and the requirement for the companies? And the most important part would be the practical case studies, because till the time we do not understand the practical aspects of the, any particular topic, it's difficult to implement in a day-to-day life and the practical scenario. And at the end, I will try to cover it up by way of providing my thoughts and views. How should companies prepare from this particular topic, and closing remarks. So that's how the agenda, have been finalized from my side to cover it up this topic in a 1 hour session. Let us start with the background of this topic. As I mentioned, it's important to understand firstly the pain area, and that's where the OECD BEPS action plan has, have been finalized by the committee. So, I mean, these are some of the, practical or some published article at a global level, wherein you all must have heard about the news, that Apple, Starbucks, Fiat, and there are many more multinational companies that has come under the scrutinized view of the tax authorities at a global level. Of course, one of the key reason to scrutinize their financial statement and tax affairs was they are earning a significant amount of taxable profit across the world. But at the same time, if someone looks at the taxes paid by them at a global level, that's quite minimal as compared to the profit which they are earning at a global level. So that's where the topic has gained importance, at a global level, that it's important to provide a mechanism to, to reduce the tax evasion at a global level, to increase the tax transparency at a global level. Of course, each country is trying to implement some or other measures. I would say, measures such as GAR, measures such as transfer pricing. But at the end of the day, if the countries do not come together and do not support each other to reduce the overall, tax evasion at a global level, this is something, it's not going to happen. So this is a pain area in last many decades. Of course, transfer pricing topic has tried to, reduce this, pain area while implementing the mechanism of, arm's length principle. But few years back, instead of, considering the increased digitalization part, considering the increase of, challenges from other areas, OECD, which is the Organization of Economic Cooperation and Development, which is continuously providing guidance on international tax topics and providing many articles and publications, have finalized OECD base erosion and profit shifting action plan, the 15 action plans to address the challenges of, tax transparency, to address the challenges of, tax evasion at a global level, to address the challenges of permanent establishment and transfer pricing. So all these 15 action plans, I would say, have been introduced by OECD in 2015. And the important, important agenda or important objective of these 15 action plans altogether was to minimize tax evasion at a global level, to increase the tax transparency between countries at a global level, and of course to address the challenges of digitalization in today's era, which was not there in the last century or last few decades. So of course that was the agenda. And after implementing this 15 action plans in 2015, all these action plan, all 15 action plans have certain different objectives. While definitely all together the objective are quite clear to reduce the tax evasion, but each action plan has certain objective to fulfill. Today, in today's part, in today's agenda, I would like to cover specifically the action plan 5 provided by OECD BEPS action plan, which is on the topic of transparency and substance. Now coming to the topic of today's part, that is Action Plan 5, harmful tax practices. While we discussed that in OECD 2015, they introduced this topic, and 135 plus countries, including India, have joined the framework of OECD to implement these all action plans. And whoever joins these action plans or whoever joins this framework of OECD are required to at least implement 4 mandatory action plans of OECD. That is Action Plan 5, harmful tax practices; Action Plan 6, that is prevention of treaty abuse; Action Plan 13, that is country by country reporting, that is also part of the transfer pricing, I would say; and Action Plan 14, that is mutual agreement process. Of course, the other action plans need to be implemented going forward basis and as per the requirement, but at least these 4 were the minimum action plans that all countries who have signatory to OECD BEPS framework are required to adhere to. And that's where this topic of Action Plan 5, that is harmful tax practices, is one of the most important topic in this 15 action plans provided by OECD. To understand what is harmful tax practices, let me give you some introduction. Harmful tax practices are those tax practices, I would say, followed by multinational, amount of profit at a global level. So of course, tax planning is one of the important part, where people can do a tax planning within the boundaries of the law to structure their operations in such a way so that possibly their potential tax liability gets reduced. But tax evasion, there is a thin line of difference between tax evasion and tax planning. So the tax evasion is those kind of practices or those kind of implementation of the policies which are slightly in line with the illegal tax practices, I would say, which are not within the corner of law. And those tax practices, of course, the objective is to reduce the tax liability and tax evasion at a global level. And the immediate objective of this action plan was to reduce this kind of harmful tax practices, to reduce those kind of group policies or group taxation structuring followed by certain MNCs at a global level. So that was the key objective of providing guidance on this particular topic. We will deep dive that in the coming slides, but to provide a detailed overview, it's important to give a background of the topic, and that's what the background is, to reduce this kind of harmful tax practices followed by a particular set of companies and MNC at a global level, so that there are no such tax evasion happening. So one of the important part of these harmful tax practices was to create a nexus based approach. I would say nexus with economic activity, because at the end of the day, if there is no nexus with economic activity, all the profits earned by multinational corporations may be a tax free profit at a global level. So it's important to by OECD to create a nexus based environment and nexus based approach while taxing any particular profitability. And they introduced a topic of economic substance during the process of this Action Plan 5. So let me just read out what the mission statement of Action Plan 5 states. The mission statement states the revamp the work on harmful tax practices with a priority on improving transparency, including compulsory spontaneous exchange on rulings related to preferential regimes, and on requiring substantial activity for any preferential regime. So substantial activity and economic activity was one of the key fundamental agenda that has been derived from this particular topic, and companies were required to create economic substance while earning any kind of profitability in other countries. So let me give you an example, how the structuring happens at a global level. Tax structuring, I would say, it happens at a global level. So for example, there is one particular ABC group, which is possibly headquartered at USA. It's having a subsidiary maybe in India, maybe in UAE, maybe in Europe and other parts of the world. If whatever profit is earned by the ABC group, maybe in USA and India, that would be taxable at a corresponding tax rate prevalent in that country. So to reduce that taxable profit and to reduce the tax liability, many of the MNCs what used to do, they used to create a company, let's say in British Virgin Island or Cayman Island or United Arab Emirates, which were a tax-free country. There was no corporate tax at the end of the day in those countries. So they used to create a legal entity in those kind of countries. They used to, structure their operations in such a way so that a maximum profit of the group, lies or, is situated in the books of Cayman Island or Bermuda or United Arab Emirates or those kind of tax haven countries. In such a way, there are no major profitability, let's say in India, Europe or USA. And at the end of the day, these tax-free countries do not provide any kind of corporate tax. And at the end of the day, their global level taxation of ABC group, let's say, gets reduced at a significantly lower level. So that is what the purpose of, OECD BEPS action plan was, to create an environment wherein they have to, pay the amount of taxable profit at the rate at which it is applicable in the country where the profit is generated. So for example, if there are no activity in, let's say, Cayman Island, UAE or Bermuda, without the activity, how can a company earns a significant amount of profit? That was a quite at a global level. And that's where the need arose, to provide a measure in those kind of tax-free countries or tax haven countries to have a mechanism uh, to restrict those kind of profitability in those countries. And therefore, many of the tax haven countries have introduced this economic substance regulations in those countries to, demonstrate that every company who is operating in this tax haven country are required to demonstrate that, profit is earned because of the economic activity. It is not just a book company. It is not just a shell company. So that was the whole agenda of this economic substance topic. So ultimately, at the end of the day, if I, summarize the key objective of this particular topic before I deep dive in this particular principles and requirement, economic substance regulations mainly increases the tax transparency at a global level. That is as a part of the, commitment of the country in the, a commitment to OECD inclusive framework, commitment to European Union code. In fact, many of these tax countries were blacklisted by European Union. Most of these tax havens were blacklisted in 2017, 2016, while they provided the list of blacklisted companies. And only after smoothly implementing this kind of economic substance regulations, certain countries were removed by European Union from its blacklist. So you can imagine what were the strict measures taken by European Union and OECD at a global level. And in order to operate effectively at a global level, these countries were mandatorily required to incorporate economic substance regulation in its own country. So that was the key objective of this particular topic, while increasing the tax transparency and at the same time to get its name removed from the blacklist of European Union. Moving forward, let us understand at a global level requirement and the countries where the regulations is existing at the moment. These are some of the major countries where the economic substance regulations is existing as on today. And if you can see, most of these countries are tax havens. For example, BVI, that is British Virgin Islands, Cayman Islands, Bermuda, UAE, Mauritius, Seychelles, Anguilla, Barbados, Guernsey and Jersey. You must have seen, at a global level, any kind of tax structuring. At a top level or at a mid level, some structuring would involve a company from Mauritius, BVI, Cayman Island, United Arab Emirates. Of course, UAE has just announced corporate tax a couple of months back in its own country. So we can say that UAE has, step up in terms of introducing the tax transparency measures and introducing the corporate tax now. But apart from other countries, they are still tax-free countries as on today. So you can see that this kind of regulations will try to reduce the tax evasion at a global level. Let us understand the detailed, principles and the requirements Of course, each country have provided its own regulations similar to corporate tax or similar to VAT or audit requirement, where each country provide its own regulations. But this is a kind of regulations at a global level. So most of these tax countries, most of these countries which we just discussed in the last slides, have provided the regulations mainly on the similar lines which is mentioned in the OECD BEPS Action Plan 5. So I can say that, rightfully, that OECD BEPS Action Plan 5 is the Bible for economic substance regulations, which is a governing document for this kind of regulations. And each of these countries have just taken a guidance and just tried to implement the same regulations in its own country. So of course, there will be certain additions or deletions in the kind of principles or requirement, but broadly the regulations is going to remain same in all these kind of tax-free countries where the regulation is existing right now. To mention that, who are covered in this kind of regulations, while we discussed that, for example, UAE, BVI has introduced these regulations, broadly, all the licensees, all the companies, whether those companies are located in the onshore, jurisdictions or offshore jurisdictions or a free zone jurisdictions in these countries, are covered as a part of these regulations. Basically, all these companies who have received either a license or a certificate of incorporation or any kind of permit to operate in its country, in this kind of countries, are required to adhere to this kind of regulations, and they are required to fulfill the requirements of economic substance. This also includes any kind of legal entity like company, partnership firms, LLC form, or any other kind of legal forms that we can imagine. Of course, the individual persons have kept out by most of the countries, but there are certain countries which has also covered individual persons who are undertaking certain business activities as a part of these regulations. So broadly, in a nutshell, all the legal companies are required to fulfill the requirements of economic substance in this kind of countries. Of course, there are certain exemptions and relaxations provided by the regulations, similar to other regulations. And broadly, if I look at all the countries' guidance and the regulations, government companies are generally kept out of this kind of requirements, assuming that generally government companies are not with the intention to earn profitability. They are generally the non-profit organizations or generally the organizations to promote a social welfare, and that's where this topic is less relevant, I would say, to government companies, because the fundamental objective is to increase the tax transparency and to reduce tax evasions, and that's where government companies are slightly away from this topic. At the same time, tax resident in other countries, for example, foreign companies who are registered as a foreign persons and are not paying any profit or any taxes in those countries, are generally kept out of these regulations. At the same time, companies which are not undertaking a relevant activity, we will deep dive of what is relevant activity in the coming slides, but there are certain set of relevant activity which are covered as a part of the regulations. So if the companies are not doing any of this particular relevant activity, those companies are not required to fulfill the requirement of economic substance. So these are some of the exemptions provided by most of these countries like UAE, BVI, Cayman Island, Mauritius, etc. And broadly, the coverage and the exemptions remain same in most of these countries which I have gone through. Now, while we discussed what are the relevant activities, so, there are certain set of relevant activities that are, specifically covered as a part of the regulations. And if the companies are undertaking any of these relevant activities, they are mandatorily required to undertake certain compliance, submit certain forms and demonstrate economic substance. These activities pertain to, banking companies, insurance companies, fund management company, lease finance company. So basically all the kind of financing companies who provides the loans are covered as a part of the regulations. Headquartered activities. So headquartered activity is not specifically a business activity, but headquartered activities is basically where the headquartered is situated, for example, in UAE, or for example, headquartered is situated in Cayman Island, or maybe the ultimate parent entity is situated in those kind of countries, are mainly said to be the headquartered activity business from this regulations perspective. Shipping companies, of course, these all kind of tax havens are generally, if you see, are mainly just an island, or mainly just a place from where it is easier to move the ships or transportations. And that's where shipping companies or shipping business activities are more prone to economic substance regulations, I would say. At the at the last, holding company, as I in a big complex structure, there are certain companies which are a legal entities, but the role of that legal entity is just to hold the shares or equity interest in other legal entities. They are not doing any kind of operational activity. They are not doing any kind of purchase or sale of goods or provision of services. They have just kept in the structure to hold the shares of another subsidiary company or hold the equity interest in another companies. So those companies are just to be said as a holding company from this perspective. Intellectual property activity. Again, this is not a specific industry or a business. Intellectual property activity means if a company is, is owning any kind of intellectual property like brand, trademark, any kind of technical know-how, and earning income from licensing those intellectual property. So you must have heard, many of the MNCs like Google or Starbucks, who are ideally based in UK or USA, but those intellectual property possibly are registered maybe in Ireland, maybe in BVI, maybe in Cayman, maybe you know so in order to license those intellectual property from this country, and at the end of the day, all the income or a taxable profit relating to intellectual property, which is a major income from this kind of MNCs, are registered in these countries. And that's where the intellectual property becomes one of the important activity as a part of demonstrating economic substance. And the last but not the least is distribution and service center activity. So distribution means a trading activity. People undertakes a trading activity. For example, many of the MNCs used to create a company in UAE, for example, where for UAE, in companies like in India headquartered, used to invoice to its related party in UAE while selling goods to UAE entity at 100. UAE entity in turn used to sell the goods to third party, let's say at 150 rupees, and earning a profit of 50 in UAE books of accounts. Definitely the shipment will directly grow from India to Europe, to India, to USA, etc. They will not pass within the boundaries of UAE, but just for the purpose of invoicing, the UAE company's books of accounts must be used by many of the MNCs previously, and to book a profit in UAE, I would say that. So those kind of trading activity or distribution activities were also being more prone from economic substance side. And the service center means any kind of services that one entity provides to its related party, again just to book a profitability, or again just to earn income from that activity without any operational corresponding operational activity, or without any substantial activity, I would say. Again, the intention was just to book a profit in the name of services without any activity, so that they can take the exemptions of expenses from the deduction of tax expenses in the other country, and booking a profit in these kind of tax-free countries. So all these activities were certainly prescribed, and these specific activities carried out by any of the companies are required to demonstrate economic substance in these countries. And the whole purpose is to say that look beyond the form, look beyond what is the contractual obligations. So importance is given to the substance in a way. So substance over form approach, we have always heard this term before while while studying for CA, while going through accounting standards or any other IFRS standards, that it's always needs to be a substance over form approach. This is the kind of regulations wherein we have to see economic substance. We have to see the conduct of the business, not just the contractual obligations. So look beyond the form look beyond the books of accounts, look beyond the contractual obligations to understand where the tax evasion is happening. And if it is happening, you have to prove now that there are certain activities while earning a profitability at a global level, or else there will be a lot many challenges going forward in this kind of digitalized era. So while we discussed all these relevant activities, we mentioned that if company is undertaking any kind of activities, they are required to provide certain informations, they are required to demonstrate economic activity. Just to give you a sense what these companies are required to submit. So for example, banking company. So banking company might have to submit or provide informations to authority relating to actual value of deposits or loans receivable in those countries. Shipping business activity company might have to provide the number of ships operated by them. So, just to see, whether are they actually undertaking a shipping business, or it is just that in the books of accounts, they are booking a income from shipping business. If they understand, or if there are a genuine activity, there will always be a number of ships which they are operating in a way. At the same time, leasing business activity or financing business activity, they might have to submit the information relating to number of loans, value of the loans given in those countries, number of leases, and the value of leases that they have operated in those countries. For distribution companies, trading companies, they have to show whether whether the particular company in those countries have taken the legal title of the goods or no, whether the inventory physically moves to that particular country, or the inventory doesn't even come to that country or no, which kind of industry of that distribution industry they are operating. At that same time, service center business, companies have to demonstrate and provide informations relating to what are the kind of services that they have provided to related party, to third parties, what is the income earned from third party, to understand whether the company is operating at an independent level, or it is just created to earn income from the related entities at the end of the day. So this kind of informations actually will help the tax authorities, help the relevant authorities to understand whether the companies are undertaking a genuine business activity or no. Otherwise, it's clearly visible. If shipping companies are not operating any kind of ships in a year, it's quite clear for authority to say that there are no genuine business activity. The company has been just created to book a profit in this particular company, but other than there are no activity. IP businesses, like I mentioned, there are certain MNCs which generally register the IP in this kind of tax havens. They have to show the substance. Who is the legal owner of the IP? What are the nature of the IP? If they are, if tax haven companies are giving the license to another related party or a third party while earning licensing income, what are the actions maybe undertaken by them to secure their IP, the legal actions to manage the IP, to protect the IP, to enhance the IP, I would say. So this kind of information would be required to provide if the company has registered the IP in these jurisdictions and earning income from that. At the end of the day, basic informations relating to to demonstrate economic substance need to be provided relating to this core activity. Of course, there are additional informations that needs to be provided, which I will discuss in the coming slide, but this is a kind of information which is specifically linked with the economic activity of the activity. Economic substance test, while we discussed the first part in the previous slide where they have to provide the direct informations of economic activity, but there are additional informations which needs to be provided. So there are three tests, I would say, to justify economic test. First is the core income generating activity, which is mainly in line with what we discussed in the previous slide. We have to justify there are actually economic or operational activity relating to the business of course, distribution or IP or shipping, etc. But number 2 and number 3 in this slide is directed and managed test, wherein companies are required to justify that the companies in these tax havens are independently operating, independently managed and directed in the country itself. So they have to, undertake the board meetings, they have to maintain the minutes, they have to have, directors on board in this kind of country. And this kind of information also is required to be submitted annually to the tax authorities, just to assess, the company is independently managed by some persons. And additionally, adequacy test, I would say, which is also one of the important tests of economic substance, to justify adequacy of employees, assets and expenses. So for example, for any kind of genuine business operations, there is a requirement to have the employees, reasonable number of employees. It can completely depend on the size and operations of the business, size and operations of the activities carried out by them. It can be 1 employee or it can be 1,000 employee, depends on the size of the operations. So they have to provide the information to the authority every year that these are the number of employees they have employed in the country. An employee can't be, registered in foreign, and they cannot work from home to provide demonstrations. They have to be physically present in this kind of tax havens. And that's where the challenge begins for MNCs now. They have to also have the adequate physical assets, like, for kind of any kind of trading company or any kind of, investment company. They might have some kind of offices, some kind of laptops, computers, a routine assets to operate a business activities. At the end of the day, they also required to have certain expenses. For example, for any genuine company, if they are earning any income, there would be certain corresponding expenses of salary, rent, legal cost, professional cost, depreciations. So definitely the books of accounts is required to have those kind of reasonable amount of expenditure. There is no threshold for employee asset and expenses. It's all a subjective exercise. It depends on, we have to deep dive the operations of the company to understand what can be the appropriate and reasonable amount of expenses, assets and employee. So these are the tests that they have to justify. They have to provide information to the tax authority every year. Like we submit the corporate tax return every year, we have to also submit economic substance return every year in this kind of country. And most of these countries have introduced these regulations from 2019 onwards, or few of the countries have incorporated regulations from 2020 onwards. And all the MNCs which has structured their operations couple of decades back, 20 years back, these structures cannot be said to be a valid structure in today's era, especially after this kind of regulations in place. Additionally, while we discuss this, what informations we have to submit for MNC, there are informations relating to, establishment of the companies, where are the branches located, who are the owners, who are the, parent company, who are the ultimate parent company, who are the beneficial owner. Beneficial owner is also one of the important regulations prevailing in many of the countries, including India, which is again linked with the anti-money laundering objective, to understand who are the actual beneficial owner. Forget the legal owner of parent company and, ultimate parent company, which are mainly located in the tax havens or any other companies, but to understand who are the actual independent or individual persons who has a stake in these companies. So it is important to provide this information as well as a part of the ESR return. Adequate number of employees, financial informations like expenses, income. We also have to submit the audited financial statement now. Previously, these companies in tax havens were not even preparing the financial statement, were not even getting audited. Now they have the mandatory requirement to submit the audited financial statement. So you can imagine the role of as an auditor, role of the tax consultant and the advisor in these countries to advise the MNCs what is the requirement and why it is important. So all these are a kind of key requirement nowadays for MNCs to submit in this kind of countries. Let us understand the practical case studies. While we already discussed what are the kind of companies or industries which are prone in these regulations, but just to give you a quick idea on the practical side, how the structure works. So first case study relates to distribution business. I already gave you some idea, for example, in this scenario, manufacturer ABC India is headquartered in India. It has created a subsidiary company in ABC UAE in United Arab Emirates, which was a tax-free country previously, and recently it has incorporated a corporate tax, but going to be applicable from 2023 onwards. So as on today, there is no taxation in UAE. So ABC India sells the goods to ABC UAE, assuming at 100 rupees. ABC UAE, sells those goods to XYZ USA, which was a third party, let's say at 150 rupees. So 50 rupees profit is booked by ABC in UAE, which is pure tax free for the ABC group. Of course, the shipping would directly happen from India to USA directly. There will not be any movement of goods to UAE, and this kind of structure previously was created possibly just to book up profitability in UAE and to avoid taxes in India, I would say, which is 30% taxes now onwards right now. So this is a kind of typical structure where the economic substance regulations, ESR, is applicable in UAE and other parts of the tax havens also, where the regulations are very similar, and they have to now, UAE company or any other tax haven countries are required to demonstrate economic substance for this kind of activity. Similarly, service center business in the second case study, for example, there is a USA parent company headquartered in USA. It has created a subsidiary company in Bermuda. USA parent company has taken the contract to provide, let's say, technical services or software services to a third party, which is in UK. So assuming USA is providing, services to UK and booking revenue of $100 in USA, which is going to be, of course, taxable at, let's say, 25% as per the USA regulations. Now, what USA has done in this kind of structure is they have created a Bermuda company and they will outsource this arrangement just for the purpose of possibly tax evasion to Bermuda. So they will book expenses in USA. They will say that USA has taken the help of Bermuda company while providing services to end third party customer, UK. So out of $100, by way of expenses, USA will transfer, let's say, $80 to Bermuda company, which is a related party, of course. From the Bermuda perspective, the whole $80 would be a tax-free because there are no taxes in Bermuda. It's a tax-free country. And USA company will show net level $20 income in USA. And, so taxability of 25% at $20 would be only $5, as against, the previously taxability would be $25, I would say. Though Bermuda company is not doing any activity, they are not going to provide any services to USA. It was possibly just to create a tax evasion structure, and this kind of structure was made. Again, in this kind of situations, Bermuda entity might have to provide, economic substance forms and demonstration of management, demonstration of employees to evade or, to restrict this kind of practices. Again, typical structures happening at a global level. And I have tried to create a kind, case study just to make all of you understand how this kind of structuring works. The third and fourth case study, we have a limited time right now, so I will just move quick and provide a glimpse of it. But for example, holding company business, I would say that as we discussed, many of the structure involves BVI company and a Mauritius company at the top level, while the operational companies like USA, India, UK, France sits at the bottom level. Even in this scenario, there is a ultimate parent company is registered in BVI, having the subsidiary of Mauritius company, and the Mauritius company in turn have a sub-subsidiary, let's say in USA, UK, and France. At the end of the day, whatever profit earned by USA, UK, and France, they remit dividend to Mauritius company, and Mauritius company in turn will give dividend and capital gain to BVI company. So we can imagine that, at a BVI level, at a Mauritius level, the whole dividend, whole capital gain, whatever, if they sell any of these shares, our whole, amount of dividend and capital gain are tax free. And this is a kind of routine structure or a typical structure, which was quite famous couple of decades back to, to create a tax evasion. Of course, Mauritius entity were also, or BVI entity were also created many of the time, just from the perspective that if they want to exit from the business, if they want to sell the shares of, let's say, XYZ, USA or UK, it's very easier for them to sell the Mauritius company itself, so that there are no taxes in Mauritius, And even in DTAA between Mauritius and other countries, generally the capital gain have kept, tax free from many of the countries' perspective. Of course, India amended the Mauritius Treaty in 2017 or 2018 to limit this kind of tax evasions. But of course, this practice still prevails. Similarly, IP business activity. For example, headquartered is situated in ABC Anguilla, which has the subsidiary ABC Cayman Island and which has subsidiary ABC India, Italy, and other countries. The IP, for example, trademark, brand, patent is registered in Cayman Island here, and Cayman Island is ultimately has given the license of this IP to Anguilla, to AB India, to Italy, and in turn, India and Italy entity would pay royalty, fees for technical services, management fees to Cayman Island entity, so that Indian entity or Italian entity, of course, will get deductible expenditure of royalty, management fees, technical services, etc., and whatever profit earned by the Cayman Island entity would be a tax free. So again, this kind of scenario where the IP is registered in tax free company or tax free country, they are required to provide economic substance now onwards. They have to show that there are employees to legally secure the IP. There are the decisions relating to IP were taken in the country of Cayman Island or Anguilla. In this kind of cases, they have to submit these forms, and tax authorities can deep dive the operations and understand the requirement, whether they fulfill the requirement of economic substance or no. So these are the typical few case studies I have created to understand the practical aspects of it. And at the end, if I summarize certain requirement from the documentation side, what companies are required to do, I would say that it's important nowadays to create a document to maintain a supporting documents relating to contractual obligations, relating to intra-group agreements. In this kind of economic substance perspective, it's important to prepare the board meetings. And the board meetings, to be honest with you, it cannot be the online meeting. Even in COVID era, where physical movement of the personals are not possible, few of these countries like UAE have specifically explicitly clarified that it is important for a person, for a director, to travel to UAE while carrying out the board meetings in UAE and to justify economic substance, or else there could be a failure of economic substance, and failure could lead to not only the monetary penalty but also cancellation of licenses, but also exchange of informations with authorities of India, USA, where the ultimate parent company or parent company is based on. So again, that's an important point I would say we didn't discuss in the previous slides. What if we discussed what is required, but what if the company is not able to justify the economic substance? So as I discussed, if for example Bermuda company, BVI company, or UAE company is failing to justify economic substance, these countries will share the information or exchange the informations with all other countries where the MNC is operating, and where the exchange of information agreement between the two countries is activated right now. Now, as I already mentioned, that as part of the OECD framework, all these countries have become a signatory to OECD BEPS action plans, and most of these countries have already activated the mechanism to exchange informations. So for example, in UAE, companies failing the economic substance, they might share the information with tax authority of India, USA, UK, that see particular ABC group is having the subsidiary company in UAE, which is tax-free country, and there are no economic activity, it's shell company, so that USA, UK, or India kind of tax authority will take action against the ABC group which is operating in those countries, and they will try to evaluate whether those kind of MNCs are actually paying taxes properly or adequately at a reasonable level in India, USA, or UK, or no. So that's the kind of consequences it may lead to if there is a failure of economic substance. And to safeguard or to justify the economic substance, like I mentioned, it's important to have the employee in those countries and employee related informations like contract, timesheets, corresponding or email exchanges between employees of those countries and other countries is required. Intra-group agreements and the transfer pricing study is also one of the important aspects to justify the intra-group arrangement. IP related document, intellectual property related document, where the legal registration is happening. What are the action taken by the companies to protect the IP, exchange of informations between two countries. So all those kind of supporting documents are required, relating to even expenses, assets, and income as well. And without these documentations, it's very difficult for companies now to justify the economic substance. And at the last, I would say that how companies should prepare, which is the key objective for us also to advise the clients, to advise the multinational corporations. Firstly, check the applicability. Wherever this kind of MNCs are operating in this kind of tax havens, check whether the regulation is applicable to them or no. Re-examine the facts, assess the applicability of the regulations, try to identify the requirement of economic substance, identify the potential gaps and the challenges area. And if you find any challenge areas, if the company do not have employees, if they have not done board meetings, advise or restructure the business model, which is quite important in today's era. The structure happened 20 years back, cannot be said to be, valid as on today's era. There are many related issues like permanent establishment issues, POEM issues, economic substance issues, VAT issues at a global level. Because of the, COVID era, there are work from home scenario, there are digitalized business activities are increasing. So it's important to restructure the business model nowadays, maintain all the documents, realign the contracts vis-a-vis conduct, where we mentioned it's important to adopt substance over form approach instead of, just the book approach or just a form approach, I would say that, and undertake the timely compliance. It's not that it's a one-time activity. Companies have to submit this information annually every year. It's important to undertake timely compliance, or it may lead to not only the monetary penalty, but also larger consequences of exchange of informations and, cancellation of even certificate of incorporation as well. And to end my session, I would say that revisit business model in line with the latest tax principles and latest tax developments. We are in a situations where we are witnessing one of the century's biggest tax reforms, wherein BEPS Pillar 1, Pillar 2 are in place, wherein minimum corporate tax has been implemented by many of the countries. UAE has just announced, for example, corporate tax. So you can imagine countries like UAE, which were tax-free in last 60 years, has introduced the corporate tax because of, as a part of OECD BEPS Pillar 1, Pillar 2. So there are lot many developments, and we have to, as a chartered accountant, we have to, be at the front of the role to advise the companies and take the appropriate actions. So thank you everyone to listen to me, patiently and understand this particular topic. And I hope I could provide some insights in this kind of 1 hour session.
In-depth knowledge on this topic, like base erosion of profit sharing, transfer pricing, international taxes across various businesses, only come with regular practices. And so much opportunity lies in such area for CA professionals. On this topic, we have queries from our participants. The first query is, how does the ESR rules change if the trading entity buys products from the connected group companies?
So that's a quite valid question, I would say. In fact, this is a kind of typical question, or a typical scenario which exists because of the tax evasion. So for example, I gave the example wherein India headquartered company, which is a pure trading company, is importing or is exporting certain goods to UAE company, which is a related party, a connected group person, at 100 rupees. And in turn, that UAE company, which is a related party of India company, is reselling those goods to third party at, let's say, 150 rupees. And that's where the, related party, that's where the connected group companies are booking the profit of 50 rupees in UAE or in other tax-free countries. Of course, if there are genuine business activities, genuine trading activities, there are no questions, or that there are no challenges, I would say. But if the UAE entity or any kind of tax-free country where these companies are created, just because of, to create or to book a profitability, just it's a paper company or a shell company just to book a profitability without economic activity, economic substance regulations is applicable to those companies. And this is a kind of typical scenario which exists in most of the scenario or most of the cases. And whenever there are related party transactions of trading or provision of services, there are 90% chances that related party or the economic substance regulations is going to be applicable. So to answer these questions, if the entity buys any goods from foreign connected persons and sells to third party, there are most likely chances that economic substance regulations is going to be applicable, and they have to provide information to the tax authorities in these kind of tax havens.
Second question from the participant is, if currently the ultimate beneficial owner of a DMCC entity is a foreign company and it changes to a UAE group, does the ESR still apply, or is there any change in it?
So it's a good question, typically, specifically linked with the UAE taxation, I would say, where UAE has already incorporated, economic substance regulations in 2019 onwards, being a tax-free country. And recently, a couple of months back, UAE has also introduced the corporate tax now. So wherever there is a corporate tax, generally the economic substance regulations is not required because there is already the tax regime exists. But for UAE, like the question says, the DMCC entity, which is a free zone entity in UAE, may get or may continue to get tax incentives going forward, even though there is a corporate tax in UAE from 2023 onwards, but free zones may get or may continue to get tax incentives. If that is the case, if the free zone companies like DMCC, DIFC or any other free zone companies are continue to get a tax incentives, or they are not eligible or they are not subject to pay corporate tax in UAE, economic substance regulations will prevail and those countries would be required to justify the economic substance to the extent they are not prone to corporate tax regime. So to answer those questions, countries like UAE, where the corporate tax and economic substance, both regulations are existing as on today, companies are required to even more careful to, pay corporate taxes at the same time to justify economic substance as well. So quite a typical scenario, but other tax-free countries like Bermuda, BVI, Cayman Island, they are still tax-free countries. They might also introduce, a corporate tax in line with OECD BEPS Pillar 1, Pillar 2, but as on today, they are just a tax-free, and only UAE kind of countries have introduced corporate tax till now. But yes, it would be a kind of quite complex scenario for those countries now.
We are so fortunate to have CA Rushabh Bora sir from UAE in India today for discussing this very important topic on OECD base erosion and profit sharing action plan 5. Thank you so much, sir, for all your inputs. It gives a very much enlightenment to all the professionals and also for the students for getting a scope in this. Thank you, sir.
Thank you so much, Sarvina, for this opportunity. And it's completely my privilege to discuss this topic. It's a quite complex topics nowadays and very close to my heart. And I thank you and sincerely wish everyone, all the best for the future and to be more prepared from the tax perspective, which is changing nowadays every now and then. So wishing luck to everyone, and thank you for listening to me patiently. Thank you so much.
Thank you, Rushabh. And friends, Rushabh is always available. He has given his email ID borarushabh92@gmail.com. We have his WhatsApp numbers. So anyone who has any query related to the whole Gulf, not only UAE or Dubai, the Gulf region, they can reach to Rushabh. Thank you, Rushabh, for your time.
Thank you, Rajkumar sir, for the wonderful opportunity. And to add what you said, not only Gulf, my role exists right now to prepare companies at a global level. I am working with 70 to 80 plus countries at a global level for these regulations or international taxations. So any kind of query, please reach out to me. I would be happy to discuss, at a personal level or a professional level, and would be good to learn from each other. That's what I always say, that knowledge sharing is important at a professional level, and would be happy to connect and discuss. So you can reach out to my email ID, contact number, or LinkedIn, anywhere, wherever you are convenient, and would be happy to discuss further.
Thank you, Russell.
Thank you. Thank you so much.
Friends, today we are even fortunate to have CA Dr. Rajkumar Audukia sir as a speaker trainer for the topic, for the next topic on non-banking financial this thing. Let me give a very brief, he doesn't require introduction, but obviously his activities that he has done for the institute definitely requires a mentioning. He served the institute in various capacities since 1998. The time even we have even not thought of becoming a chartered accountant. Presently, he's serving the ICAI as Central Council member, and also he's the chairman of the CPE committee, CECL and EAN CDS Directorate of ICAI. CA Dr. Audukia sir has left no stone unturned during his career span, expanding to more than 37 years. He is a pioneer of many areas of practice which were never thought before by the profession. He served as the president of GST Research Foundation, is the chairman of Association of Indian Investors and vice president of All India Insolvency, Trade, Taxation, Finance, Real Estate, the Insolvency and Bankruptcy Code, IPR banking laws, emerging technologies like AI and blockchain, to topics relating to profession and personal growth. Is the winner of the National Book Honor Awards in 2018. CA Dr. Audukia sir is very passionate about learning new things and believes in self-improvement is a permanent process. I would say only these words: Guru Brahma, Guru Vishnu, Guru Devo Maheshwaraya, Guru Sakshat Parabrahma, Tasmai Shri Guruve Namah. He is a mentor for many chartered accountants like me and others. Sir, we would like to hear you on the topic of non-banking financial calculation.
Thank you, Sarvina, and thank you, the excellent team of ICAI, CA Deepika, Sri Sudhanshu, Sri Krishnakant, Ms. Reena, and co-faculty for this session, Hardik with me. I'll introduce the topic for 15 minutes, and then Hardik will talk from 5:15 to 5:30 or whatever time he needs on non-banking finance company. Now, this topic of today, I'm sharing my screen. Hardik, you are able to see my screen?
Yes, sir.
Thank you. So the topic is revolving around NBFI, Nidhi Company, housing finance companies, NBFCs, money lenders, cooperative credit society, and other players in finance domain. And what are the opportunities? So first, I have put a quote that positive mind finds opportunity in everything, and negative mind finds fault in everything. And in Bhagavad Gita, there is Sloka 6, verse 6 in chapter 6. Those who have conquered the mind is the best friend. And those who have not conquered, they don't need any other enemy. Mind is the worst enemy. So if I feel that I want opportunity, and opportunity comes like what Vivekananda says, now this field of non-banking financial institution, the professional fees for one work may be 2 lakhs, 10 lakhs. What is finance? We chartered accountants are considered PhD or super PhD in finance. So finance, as we say, is collection of money, spending money or giving the money, and the management of the money. So investing, borrowing, lending, all saving is finance, and finance we can divide into four main segments: personal finance, private finance, public finance, and corporate or business finance. And the total finance is 37 trillion US dollar. And there are about 448 companies. And banking, now we are discussing NBFI. So distinction is between banking and non-banking. Now, as we know that banking is governed by Banking Regulation Act 1949, and banks, the regulator is Reserve Bank of India under the Ministry of Finance. So banking is defined as the company which transacts the business of banking. And there are 12 public sector banks, 22 private sector, 46. So those who are saying that there is no work in banks, see, there are three clauses in first schedule: clause 5, clause 6, clause 7. Clause 5 says securing the work. Clause 6 is soliciting the work. Clause 7 is advertising the work. Sarvina, I am asking a question and I want to see the answer in chat box. Can I write to all banks that please keep my firm profile, Aduke and Associates, on your panel for stock audit, inspection audit, revenue audit, credit audit? Can I do that? Is it violation of code of ethics? Can I do that? Write yes or no. Sarvina, if you can see some answers. Parth, will you assist us? Technical team. Parth, will you answer? Or give the admin control to me? Anyway, so there are 1,500 urban cooperative banks across the country and 96,000 rural cooperative banks. And then bank credit is 110 trillion US dollar. So I'm just giving you this statistics to tell what is the significance of finance sector. Now I'll go directly to the distinction between banking institutions and non-banking institutions. Major distinction is bank gives a checkbook. Like I can issue 100 checkbooks, 100 checks every day. NBFI cannot issue checkbooks. They cannot issue demand drafts. And banks have a license to do banking business, but NBFI also needs a license. NBFC needs from Reserve Bank. Housing finance company are also now governed by Reserve Bank to give a license, and then National Housing Bank monitors them yearly. Money lenders need a license from the state government. Nidhi company need a license from Ministry of Corporate Affairs. Cooperative Credit Society, if they are state cooperative credit society, needs a license from Registrar of Cooperative, and if they are multi-state, from the Registrar of Multi-State Cooperative Societies. Now, maintenance of reserve ratio, this is in banks, but in non-banking financial institutions, there is a reserve requirement or net worth requirements. Banks can accept demand deposit. That means payable tomorrow. The NBFI cannot do that. Now, there are other institutions who are non-banking financial institutions, but they are not governed by Reserve Bank because there is a separate regulator, like insurance companies by IRDA, housing finance companies by National Housing Bank, stock broking, merchant banking, mutual funds, venture capital. These are by SEBI. Chit fund companies are regulated by the state government. There is a central act called Chit Fund Act 1982. And there are unregulated chits. You know, there are private chits. Sometimes they are called BC. Then Nidhi companies are under section. There is only one section, section 406, under chapter 26 of the Companies Act 2013. And there are about 300 plus companies which are Nidhi companies. Nidhi is a Hindi word. Nidhi means wealth. And if we go to Vedant, there are 9 kinds of Nidhi. Now Nidhi. NBFC by Reserve Bank, money lenders by state government. Each state, you know, under Constitution of India, in second schedule to the second part 2 of the 7th schedule, there is an entry 30 where money lenders will be regulated by state government. Cooperative Credit Society are regulated by Registrar of Cooperative Societies. Cooperative banks are regulated by Reserve Bank. And the Asset Reconstruction Company, ARCs, are under SARFAESI Act. From 1st December 2016, we have only ARC. Earlier, there were 2 categories, Securitization Company and Reconstruction Company. So they are given license by RBI. Now I'll cover in 5 minutes some Nidhi provisions, and then I'll request Hardik to address on NBFC. Now Nidhi means Sampati, and there are total 245 Nidhi companies. So they are private limited, public limited. So there is section 406, which has 5 sections, 5 subsections, and there are Nidhi rules. So every company which is a Nidhi company must contain the word Nidhi. And the important feature of Nidhi is, it is like Cooperative Credit Society. They can receive money only from members, and they can give money back only to members. So the whole purpose of Nidhi was to help small persons to encourage savings. Nidhi companies are also known as a mutual benefit society. There is a minimum paid up equity share capital of 5 lakhs, net owned funds of 10 lakhs or more, and the ratio of net owned funds to deposits cannot be more than 1:20. In CARO, there are 21 clauses in CARO. Clause 12 talks about Nidhi company, that Nidhi regulations are complied with. So number of companies are very less, but we need to know about what they do. The deposits can be 6 months to 60 months, recurring deposit 12 months to 60 months. So interest rate is maximum 2% above the rate allowed by nationalized banks. And then there is a other requirement that Nidhi company can provide loans to its members where total amount of deposit is less than 2 crore up to 2 lakhs and things like that. So this is there in the rules, where the total amount of deposits is more than 50 crore, then they can give 15 lakhs. And there are various forms in the rules. So NDH4 is for the incorporation of a Nidhi company. There are statutory compliance, NDH1, within 90 days from the financial year, they have to file this form. Nidhi cannot deal with chit funds. See, I'll discuss with the chit after Hardik deals with NBFC. And Sarvina, you remind me. So we are talking of regulated cheats. Nidhi cannot deal with hire purchase, leasing of finance, insurance business, securities business. There is a concept of standard asset and non-standard assets, NPA. More than 12 months outstanding is an NPA. So substandard asset, 10% provision is required. Loss asset, 100%, like what we do in a bank. So what I will do, I'll cover cheat and then I'll ask Hardik to deal with NBFC. The Cheat Funds Act 1982. Before that, there was no central act. This act abolishes. Before that, there were state legislations. Andhra Pradesh, Karnataka, every state, because state used to govern the cheats. And the regulator of the cheat is registrar of cheat. Now the GST officer within the state is normally the registrar of cheat. And there are 90 sections divided into 13 chapters. There is a person who is a manager called foreman, and he can take commission up to 5%. So normally what happens in a cheat, suppose there are 20 subscribers and it is for 20 months. Every month there will be one subscriber who will get the money. So suppose it is of 1,000 each. So 20,000 will be collected every month. And 5% of 20,000, that means 1,000 will be the commission of foreman. And 19,000, 19, will be given to one of the person whose draw comes, who is called prized subscribers. And all other 90 will be non-prized subscribers. In the next month, out of 19, somebody cheat will be picked up. In third month, out of 18, somebody cheat will be. So there are provisions like termination of the cheat. There are winding up of the cheat. There are disputes and arbitration. So cheat is a transaction. It is called chitti also, puri also. And what is in the market, 20 people, 10 people come together. They contribute, say, 10,000 every month. Various female members, Sarvina, you must be knowing there are cheats in all cities. My wife is also a member of a cheat fund, but those are not regulated. These are informal. So it is a transaction where a cheat is drawn. Who becomes a prize subscribers. So there is a cheat agreement under the regulated cheats. There are cheat amount, cheat business. Foreman means a person who under the cheat agreement is responsible for the conduct of cheat. Prize amount, prize subscribers, and the duration of cheat shall not extend 5 years from the date of commencement. Special permission, it can be 10 years. The discount amount up to 30% of the cheat amount. The 2 copies of cheat agreement is required to be filed with the registrar. The paid up capital is not less than 1 lakh. So like that, cheat agreement will contain the name and residential address of every subscribers and things like that. So I'm not going into each clause of cheat agreement. So it's a very comprehensive document. The foreman is one who conducts the cheat, and the cheat can be terminated by refunding the money to all the subscribers. The registrar of cheat can inspect the books, and even RBI has a power to inspect cheat books. There can be winding up of cheats. under Section 48. The disputes in the chit business can be resolved by the foreman and can be resolved by the arbitrator. Then there can be a recovery of the money if the foreman is not giving the money. There are penal provisions. Most of the non-banking financial institution, for any default, it is a criminal offense. So Section 90 of the Chit Fund Act 1982 repealed most of the state legislations. So in a sequential order, Hardik, the PPT now contains NBFC, which is your domain. Over to you, Sarvina.
If receiving so many queries from the participants who are viewing you, sir, we'll take the questions of all the participants at the end of the later 15 minutes. So
we will like to take now.
We are taking the queries for in relation to chit fund.
Yeah. No, whatever queries you come so far, we will take up them and then we will request Hardik to address.
Yes, sir. So have been wondering for long as to why NBFI are not allowed to lend working capital facility, non-banking facility to borrow, and do we see any foreseeable changes in it?
No, the whole purpose of NBFI is to assist. They are not meant to give working capital loan. They are not meant to obtain like a current account. They will. So I don't see a foreseeable future. And in the whole world, there are money lenders. In the whole world, all countries, there are non-banking finance companies. There are chit companies, and they work on the similar fashion. And if we see the old movies, 5,000 years back, 10,000, there were money lenders. So the system is okay. Yes, Sarvina. Next query.
We'll take forward the topic of Hardik, sir, and then gradually coming. So participants, please keep on posting your queries. We'll take it in the last 10 minutes of the session. I would like to introduce our next speaker guest, CA Hardik Choksey. He is a senior partner at Choksey & Choksey LLP since 2003. His areas of practice is taxation and risk advisory, forensic, digital transformation, and restructuring. He has co-authored books for the ICAI and Bombay Chartered Accountants Society on Practitioner's Guide to Audit of Small Entities, edition 2019, on non-banking financial companies for treasury. He has also given papers on long-form audit reports for banks, brand building, overview of accounting standards for non-company entities, and interplay with ICDS, forensic, due diligence, and professional skepticism. Being a passionate profession, C. Hardik Choksey undertakes mentoring of professional firms and believes technology and networking will pave the future growth of our CA profession. Sir, we welcome you on deliberating on the topic of non-banking financial corporations.
Thank you, Sarina, for your nice introduction.
Hardik ji, little louder. Put volume to 100%.
Am I audible now?
Little better, but still the volume is less.
This is the highest. Sure, I'll just try.
Yeah, go ahead.
So, good evening, everybody, and happy Gudi Padwa to everyone. Thank you, Rajkumar ji, for this gesture of inviting me on this topic on law and planning of NBF institutions. So, when we look at NBF institutions, the first thing which comes up to our mind is that what are NBF institutions? I mean, at the end of the day, it covers everything which are not a banking institution. So I would look at it as a classified heterogeneous group of financing intermediaries, which will get covered into an NBFC, housing finance companies, capital market intermediaries, insurance, chit funds, media companies, and of course, each of them having a principal regulator, being the RBI in the case of NBFCs, National Housing Bank, and housing finance companies, SEBI, insurance or capital market intermediaries, and so on and so forth. Of course, there would be other intermediaries also, and kind of an interplay would always exist with other regulators depending upon the kind of entity that the non-banking financial institution would be registered under. Of course, specific exemptions have been given by the RBI in such a situation, especially in the case of which are governed by them. In the case of housing finance companies, broking companies, Navy companies, insurance companies, chip fund companies, these are typically, of course, they are NBFCs, but they are exempted from the registrations which are required under the Section 45 IA of the RBI Act. Some of the key issues on NBFCs are, I'm sure the audience is very well aware of it, but of course, a major issue which comes up is the assessment of the principal business, whether the 50-50 test, that is, whether 50% of the income is coming from the financial income and 50% of the assets are financial assets. Both these tests, of course, needs to be, be complied with if the classification of the same needs to be done for an NBFC. Of course, there are situations which everyone comes across that in a particular year, whether a 50-50 criteria gets hit, would that also mean that the entity needs to be classified as an NBFC? I would say no, that would be a case-dependent situation, and depending upon the main objects of the business, the 50-50 test criteria has to be also be seen in intervening period. There is a 50-50 test compliance happening. Classifications, of course, the NBFCs could be classified into multiple segments depending upon the nature of activities. AFCs, of course, being asset finance companies such as vehicle loans, personal loans, and so forth. Investment companies, these are, of course, typical businesses which are only investment activities. Loan companies, infrastructure finance companies. CIC, non-deposit system related important. CIC would be a core investment companies where the asset size are above 100 crores. These are largely family-owned companies or promoter group companies where they typically do more of investments. Microfinance institutions, factoring companies, and of course non-operating finance holding companies. And this would be typically in the structure of a bank. A systematic important NBFC would be an asset company where the asset size are above 500 crores. Key issue which comes up, that whether acceptance of money, money circulation, or any multi-level marketing or any pyramid activities would be NBFC, or would it be an activity which is prohibited. These are activities which are prohibited, and they need to be ensured that these activities are registered with the entities before any acceptance. This could be by the RBI or the local state governments. So, of course, multi-level marketing is something which is not permitted. Pyramid activities, of course, is something which is not permitted. When we have multiple NBFIs, the most important point comes up with the structural arbitrage. Various laws and regulations offer the structural arbitrage. These are, of course, due to the concerned legislative and licensing framework which have been reached in any kind of a regulatory framework. So let's say, each law will have its own requirements, whether, for example, CRR, SLR requirements will vary between the bank and NBFCs. Voting rights would differ for an NBFC and a bank. Reporting requirements would vary for a company which is a Navy company or a company which is an NBFC. So, of course, the structural arbitrage is something which is most critical when we are assessing the nature of activities to be registered under. Some of the recent events which have just come up, and I thought I should bring it out to the notice of this gathering. Scale-based supervision by the RBI with effect from October 2022. A scale-based reporting supervision to be there. Effectively, they want to replace the existing methodology of classifying entity as systematic important or non-systematic important entity. This, of course, classification of the NBFCs will be on the asset size. Only this scale-based supervision by the RBI is only for the NBFCs at the moment. So, just to give you a brief oversight, which we discussed, the NBFCs are investment companies, business lending, asset financing, microfinancing, factoring is something that we discussed. Under this framework of the scale-based supervision by the RBI, typically a four scale-based layers for regulating is applicable. So a base layer, middle layer, lower level, and top layer is something that will be there. These layers, the RBI will classify these NBFCs based on certain criteria, which I will discuss in the next slide. And based on that, the supervision will be done by the RBI. All NBFCs to be identified within scale and they will be under one of these layers going forward. Just to give you an example of the scale-based supervision, how this would typically look like when the regulator is governing it. So let's say a base layer, non-banking financial company, non-default NBFC with asset size of less than 1,000 crores. Or upper layer, non-banking NBFC something which is specifically identified by the RBI for being subject to enhanced regulatory requirements. And of course, then the top layer, which is the highest level of supervision that the RBI will look at, which will be typically, to where RBI will require, NBFCs to communicate higher capital requirements, or NBFCs which it believes are systematically important and have substantial systemic risk. So again, this scale-based supervision will be a very important aspect for the NBFC, and of course, this offers a new opportunity for the professionals from the members of the industry to guide their clients on how this supervision framework will work. Just to give you a very quick oversight of the opportunities which are coming up in the NBFI sector post, of course, now that they come out of the shadow of COVID-19. On the advisory front, considering that there's a lot of regulations that are applicable, a comprehensive compliance review of various laws, resolution of assets, many of my audience members will be doing so. It could be IBCs, valuation, restructuring services, supporting for recapitalizations, post-COVID, of course, this will be one of the major points where we are finding now listed companies and unlisted companies coming up with bond issues and the need for higher capital requirements, regulatory requirements too. Advising the management from commercial perspective and assisting the commercial reviews of various documents. Mitigation risk is becoming one of the major concerns post-COVID, and the chartered accountant would be expected also to provide some kind of service on commercial reviews, especially. And of course, reviewing the roles of business correspondents, supporting financial inclusion. Many of the NBFIs are the key objective, of course, being financial inclusions, and a lot of transactions happening to business correspondents, considering that possibly geographically to reach out to every the last mile customer in Europe in the past for the business correspondents have been done. The review of roles of these business correspondents would be a key objective of various entities. Technology impact on non-banking finance institutions, automation of processes post-COVID, something that the chartered accountant can devise. A lot of things like robotic automations to happen. Cybersecurity, one of the biggest risks which is facing any industry today, and cybersecurity and the NBF sector again, exclusion out here. Blockchain, of course, is something which is an emerging area of practice, but of course, sometimes we will work further as entities start implementing blockchain into the systems. ESG lending, again, in the banking sector, ESG lending is something which is slowly picking up. But going forward, I would see that in the NBF sector also, this ESG lending will be there environmentally and sustainable and governance standards have also been identified. And so I feel that chartered accountants could play a very prominent role here, especially in sustainable lending, like developing risk assessment models or assessing whether businesses are ESG compliant. With this, I would just thought I would bring up these new opportunities and thought it would make this to be useful for our members. Thank you very much. I'm happy to take any questions from everyone.
Very crisp and clear on the topic on NBFC. Hardik sir has taken us through the very important topics, the very important points and keys to be kept in mind. I would request CA Dr. Audukya sir to please also take us to the little detail that he just tipped onto the Nidhi and chit fund thing.
Thank you, Sarvina. Thank you, Hardik, for enlightening all us on NBFC. Hardik has written a book on NBFC, which is published by Bombay Chartered Accountant Society. So he's and that is what I want everyone to be: a thought leader, to be a writer, to be a speaker. God has given us all the ability. We ourselves limit our ability. You know, I have not written a single page. I have not spoken anywhere. Everyone, any expert was a beginner on the first day. We do not become expert on the first day. We become expert as we keep on doing. Now, coming to the rest of the topics on non-banking financial institutions. And though we could not hear Hardik sir very clearly, maybe technology impact, but if there are any query, we have his contact details, and I request participants to, they can email the query, and we will improve the system. Mr. Sudhanshu, we will see that we upload the PPT on our CP portal. We give the contact details of the faculty so participants can ask the queries. Parth, I want to know how many participants are there on today's webinar. Sarvina, Parth is not responding today. I see his name, technical support. Yes, Deepika.
So there are more than 1,300 participants for today's seminar.
Thank you, Deepika. But Mr. Parth should respond whatever we are asking. Now I go to housing finance company. Housing finance companies are, you know, again in the larger umbrella of non-banking finance companies. But housing finance companies need to have a license now from Reserve Bank. Earlier, this license was given by National Housing Bank. So license is given by Reserve Bank, like how for a cooperative banks, the control is taken over by Reserve Bank. So on housing, like, you know, Hardik gave a test 50-50. So for NBFC, there should be at least 50% income and 50% assets should be in the financial activity. Similarly, for housing finance company, 60% of total assets should be in the housing finance sector. And 50% of the total assets must be for financing of houses for individuals and providing loans to individuals, providing financial options for construction of dwelling, mortgaging, and all these activities are done by housing finance companies. They also get loan from National Housing Bank, and there is a master direction of National Housing Bank where there are compliances by housing finance company. The regulatory framework for housing finance companies is that there is a National Housing Bank Act 1987, so it is a body corporate, and then there is a housing finance company Reserve Bank Directions 2021. So this apply to all housing finance companies, and this direction is divided into 4 sections with 17 chapters, and there are 6 annexes. The net owned funds is 20 crore to be housing finance company, and it is a company under Companies Bay. Why we call NBFC? NBFC means it is a company under Companies Act. Chit fund can be anything. It can be a sole proprietor, it can be a partnership, it can be LLP. The objects for HFC Similarly, money lenders. Money lenders can be any form of organization, individual, HUF, partnership. The registration of housing finance company, we have to, similarly, national NBFC. We have to upload the application on the Reserve Bank website, even for asset reconstruction companies. And the professional fees for NBFC, HFC, one single registration, it can be from 10 lakhs to 15 lakhs. So even if we get one or two work, and there are not many professionals who knows about these activities. There are mandatory compliances for housing finance companies. They have to file annual return, half-yearly return, and quarterly return in respect of the prudential norms. See, any person who gives the loan, we know about banks because we do bank audit, so we know about standard asset, doubtful assets, loss assets, and the prudential norm, IRAC, income recognition norms. Then copy of financial statement and annual report. The Ind AS provisions are to be complied with. Then I come to cooperative credit society and cooperative banks. So, there are the state cooperative, Sarvina writes a lot of articles, there's a website, e-societies. I was reading the articles and I have requested her to do a program for Gujarat state, Gujarat cooperatives. So this cooperative is the business entity. There is a society under Society Registration Act 1860. That is a charitable society. So we can have a charitable society or a charitable trust or Section 8 companies, or in some states there is a non-trading corporations. This cooperative, the word cooperative can be there only if the society is registered under Cooperative Act. So in Maharashtra, we have Maharashtra Cooperative Societies Act 1960. Similarly, there is in each state and in union territories also there is a Cooperative Society Act. And then there is a Multi-State Cooperative Societies Act 2002. A cooperative society which functions in more than one state, they have to take a registration with the Registrar of Multi-State Cooperatives, who is in the Department of Agriculture and Cooperation. So when I'm talking of credit cooperative society, it can be state credit cooperative society or it can be multi-state credit cooperative society. There is another terminology, multi-level marketing, that is totally prohibited. That cannot be done either by a society or by any other entity. So, Multi-State Cooperative Societies Act, there are 126 sections, 15. These are all very small legislation. If we can read Income Tax Act or GST Act with comma, full stop, inclusive definition, exclusive definition, these legislations are much simpler. There is a central registrar. Then the bylaws of the cooperative. See, in the cooperative sector also, we are going more for audit. But my strong suggestion is go for consultancy, go for registration of cooperative society, go for management of cooperative societies. So the bylaws contains various provisions. So I'm not going into detail of that. There are federal cooperatives. Then I come to money lenders. Now money lending is a sort of a non-banking finance institution, and money lenders, like in every city, we see that there are money lenders who give the loan against gold ornaments, especially the poor people, the agriculturists. They take this kind of finance, and there used to be, very exorbitant rate of interest, and these borrowers would never get back their assets, and therefore this regulation of money lending came. In fact, Reserve Bank has been making an attempt. There is a report of 2007 where they wanted a central money banking act, like how we have a Chit Fund Act 1982. There is a central act, and there are state rules, like how RERA, we have a RERA Act 2016 and RERA rules in each state. So in Maharashtra, there is a Maharashtra Money Lending Act 2014. It has 57 sections, and business of money lending means the business of advancing loans, whether or not in connection with business, or it can be private, and they are eligible to accept the assets as a mortgage, as a pledge. Money lender can be individual, HUF, company, other than NBFC. NBFC can't do money lending business. So it does not include government, local authority like this. Then there is a definition of trader. Then I come to, and here also there are money lenders also have to file annual return, keeps the books of account. Now I come to asset reconstruction company. Asset reconstruction companies are also NBFC, and they are regulated by Reserve Bank of India, and they are under SARFAESI. There is an act called Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. And from 1st September 2016, there was an amendment, and we have ARC, and there are 28 ARC. Those who are, they take the substandard assets. So especially in the NPA sector, like now government has started a national ARC. So this is again a very small legislation which will help in practicing in these areas. And there are guidelines and directions where the name is still the old name, Securitization Company and Reconstruction Company directions. Net owned fund of ARC should be minimum 100 crore. This is from April 2017. Then like bank, the standard assets and non-standard assets. Like when we call an asset non-performing, when we do not get an interest or we do not get the installment back. So substandard is like for banks, for period not exceeding 12 months. Sarvina, we did not get an answer to the question, no? If I apply to various institutions, I did not, like yesterday, Arun was a faculty where the poll was created.
Correct.
Like how we create a poll on LinkedIn and Facebook. So the answer to my query is yes, we can apply everywhere. But we will not say, give me the work. We will say, keep my name on the panel. It is the same thing. Meaning is same.
Would you updated it onto it? Because it was a query on everyone's mind, whether we can apply for it or not. But at least if we are empaneled, then people know that this kind of a work is also been taken care of by the professionals. So then it will come on, it will keep on coming to us.
Like Sarvina, in each cooperative bank, I can send an application. Each private sector bank, I can send the application. Each foreign bank, I can send an application. And I am bound to get the work. I have been getting the work of that kind. And then in SARFAESI, there is a DRT and DRAT, because asset reconstruction companies and banks, they can make an application in DRT for recovery of the money. Are there any questions, Sarvina?
No questions from the participants so far. Who was there? We have taken that.
Participants not raising the questions.
So this is the first day for this Gudi Parva and everything. They are onto a festive mode, but they are more into the learning kind of absorbing, because this topic of NBFC is like a Pandora box. Not many professionals or small practitioners like me have tried to explore on this topic. So here more of is to learn out what is in store for us to take out, rather than, ask. The query would only come when I have put my hand onto it and I'm stuck. So if I have the bird's eye view, if I start practicing in it, then all the participants would come back and, be in touch with the expertise to get a resolution of their problems.
Very true, Sarvina, because in India, I do not find more than 20 professionals who may be knowing this subject. And I mean it. So therefore, each one of us, we should look at this subject. And, there is a separate act called Deposit Banning Regulation Act 2019. Similarly, under PMLA, there are a lot of, each financial institution, they are required to have a compliance officer. There are monthly return, yearly return. So under PMLA, one is to, if there is a money laundering, that means money has come from, they have specified under schedule various offenses. So the FIU India, Financial Intelligence Unit India, every country, the regulator is known as a FIU. And there is an international federation called FATF, Financial Action Task Force. So we have to do KYC, know your customers. So manage records. Then there is an act called Fugitive Economic Offender. Those who have, laundered more than 100 crores. Then there is a SEBI Master Circular on Anti-Money Laundering of 2019. This applies to mutual funds, other entities regulated by the capital market regulator SEBI. Now, Nidhi Company and NBFC, I have put a distinction because Nidhi is also a company under Companies Act 1956. 1956 is an old act, Companies Act 2013. So Nidhi Company is governed by Section 406 MCA. NBFC is governed by RBI. Nidhi companies are, for the purpose of small saving. And therefore, the earlier question, working capital will not be given by non-banking financial companies, or they can give a loan on asset, but not on day-to-day activities. NBFC also provide assistance. There are microfinance institutions. Nidhi company cannot do chit fund, lending. Nidhi company will collect the money from the members and give the money to the members. NBFC can give the money to anyone. Nidhi company cannot acquire securities in the form of stocks or shares. It is not eligible to issue preference shares. It cannot open a current account, or therefore they cannot give working capital. Nidhi company can have branches, and Nidhi company requires a minimum 10 lakhs. NBFC requires minimum 2 crores as a net worth. There are total 245 Nidhi companies, and there are total about 9,500 NBFCs. There are total cooperative societies, about 1,500. Total chit fund company, it's an old statistics, is 10,000 in India. Now I've just listed down various global professional opportunities in every every kind of NFI, because they are across the world. The laws will differ. So the formation, audit, internal control, cyber security. I've given some websites, and I have talked about conscious mind and subconscious mind. Now we are talking at a conscious mind level. Subconscious is, maybe 1 crore times more powerful than conscious. When we talk about ourselves, we should be very, very positive that I can expand practice in any areas. I will have the client from globe. I'll get 1 client every day or 5 clients, whatever is the goal.
So one of the participants wants to understand how the deposits can be accepted by NBFC housing companies. What percentage of deposit can they held in securities? If they're accepting, can they held these, what is the percentage they can invest or deposit in securities?
Hardik, would you like to answer this query? If you are there. What I will do, Sarvina, I will come back to that participant. If that participant can put an email ID. Hardik, would you like to answer this query?
Can you repeat the question again?
I'll repeat it, sir. How deposits can be accepted by non-banking finance corporations, housing companies, and what percentage of the deposits can be held in securities?
Deposits would be, a non-banking finance company which is permitted to accept public deposits can only accept the public deposits. That's the first most important point. Any NBFC which is not permitted, allowed to accept public deposits cannot accept public deposits. Of course, the criterion has been laid down for the CRR, SLR calculation purposes in the NBFC guidelines on regard to the percentage of investments, especially which has been classified largely into government securities, treasury bills, etc., where the requisite weightage have been given for Tier 1 and Tier 2 capital, and basis that the investments could be done in the various securities from intent of capital.
Still, Sarvina, the querist can put a email ID, and we will interact with the querist in detail.
Participants, you can keep on sharing your queries. You can also email us all the relevant queries that you are getting, so we can respond you back on the email ID with a specific case study.
Then, you know, I'm just saying that it is our duty. There is a book called Science of Getting Rich by Wallace Wattles, written in 1910. If I know NBFC, the whole world should know that Rajkumar Adukia is knowing NBFC. If I don't reach out, I am doing a crime. So it is not, there is a distinction between marketing and advertising. So marketing is to find out the needs of the users and to reach to them. So by making ourselves visible, we should create a website, we should share the knowledge in a webinar. There are online portals, there are business magazines, there is a YouTube channel, and there are whole social media platforms, Facebook, LinkedIn, Insta, Twitter. There should be personal networking. We should, from the Google, find out where the NBFC or the relevant areas where we want to practice. Those events are happening. And then I have listed out certain opportunities which are non-traditional opportunities. So maybe we will put this PPT on the CP website, and I will end my session here. There is a mind mapping technique of Tony Bhujan. Tony Bhujan, you know how maybe 500 pages we can put on one page and we can remember. Like say Companies Act, there are 29 chapters. So I can draw 29 lines divided into 400, total 470 sections, and there are 7 schedules. So जो दिखता है वो बिकता है. So be visible, use social media, and there is a book called Think and Grow Rich, very celebrated book by Napoleon Hill. So the 13 steps to get anything: burning desire, 100% faith, even 99.99 will not do, auto suggestion, specialized knowledge, imagination, organized planning, decision, persistence, power of the mastermind, enthusiasm, subconscious mind, brain, and sixth sense. If there are any more questions, Sarvina, we can take it. Otherwise, we will call it a day. And thanks to you, Rushabh, and the whole CPC team. And Mr. Hardik. Yes, over to you, Sarvina.
It was a sincere thank to CA Rushabh Bora, CA Hardik Choksi, CA Dr. Rajkumar Adukia sir for such an enlightening session. The fourth webinar, the VCM meeting for CPE committee, was so informative because those both topics on OECD BEPS Action Plan 5 is an untouched arena and a whole gamut of opportunity for the CA professionals. And equivalently, the NBFC is again an untouched and whole gamut of professional opportunities for chartered accountants. Even Rajkumar Adukia sir has written a paper on the NBFC. I was going through the entire article of yours, sir. It is a plain vanilla, simple language written. A professional, a student, even a business person, if he reads, would understand all the terminologies step by step going through the entire paper. All the materials are available for our participants and they may refer it anytime. Thank you all. Thank you, participants.
Thank you.